A choice made in the boardrooms of power that set in motion a chain of events leading to the largest bankruptcy in US history and triggering the 2008 global financial crisis. This isn't just a story about numbers on a balance sheet, it's a cautionary tale about hubris, a story of how one decision, one moment of collective denial, can bring a giant to its knees. Welcome to The One Decision, where we explore how famous companies collapse because of a single critical choice. One meeting, one decision, total collapse. They found a way to take these risky mortgages, bundle thousands of them together into complex financial products called collateralized debt obligations, or CDOs, and sell them to investors all over the world. The thinking was, even if a few homeowners defaulted, the vast majority would keep paying. The risk was spread out, so it seemed manageable. For a while, it worked brilliantly. The profits were astronomical. Lehman Brothers, under the leadership of CEO Dick Fuld, nicknamed the Gorilla for his aggressive style, became one of the biggest players in this market. They weren't just selling these mortgage-backed securities. They were buying them up for their own portfolio, convinced they had cracked the code to infinite profits. While some in the market were starting to get nervous, seeing cracks appear in the housing foundation, Lehman did the opposite. They decided to dramatically increase their leverage. Now, leverage in finance is basically using borrowed money to amplify your potential returns. If you have $1 and borrow $9, you now have $10 to invest. If your investment goes up by 10%, you've doubled your original dollar. Amazing, right? But if it goes down by 10%, your original dollar is completely wiped out. It's a double-edged sword. Lehman's leadership made the decision to push this leverage to the absolute limit, and then some. They went all in on the real estate market, particularly commercial real estate, and those risky mortgage-backed securities. Their leverage ratio soared to over 30-1. That means for every $1 of their own capital, they were playing with over $30 of borrowed money. They had built a skyscraper of debt on a foundation of sand. This was the one decision. The moment they chose to ignore the warning signs and press the accelerator instead of the brake. They believed their own hype. They thought they were too smart to fail, that the housing market would never truly collapse on a national scale. It was a level of risk-taking that was breathtaking in its arrogance. Why did they do it? A potent cocktail of greed, competition, and denial. Wall Street in the mid-2000s was a high-stakes game. Firms like Goldman Sachs and Bear Stearns were also making huge profits. The pressure to keep up, to post bigger and bigger quarterly earnings was immense. Dick Fuld and his team were celebrated as geniuses. Their bonuses were enormous. Admitting the party might be ending would mean turning off the profit machine. It would mean admitting they might be wrong. And in the culture of Lehman Brothers, that was unthinkable. Internal warnings were reportedly dismissed. The firm's own risk managers who raised alarms were sidelined. The leadership was in a bubble, surrounded by people who reinforced their belief that real estate was a one-way bet. They saw the housing market not as a potential danger, but as their ticket to becoming the undisputed king of Wall Street. This decision to leverage up so aggressively wasn't a mistaken calculation. It was a mistaken judgment, a failure of leadership to confront an uncomfortable reality. They were addicted to the returns and they were willing to bet the entire 158-year-old firm on one more roll of the dice. The first tremors hit in 2007. The housing market started to wobble. Homeowners began defaulting on their subprime mortgages in record numbers. Suddenly, those safe mortgage-backed securities that Lehman and others had sold around the world turned out to be toxic. Their value plummeted. For Lehman Brothers, with its 30-to-1 leverage, the effect was catastrophic. For every dollar their assets lost in value, it was like losing $30. Their capital was evaporating at an alarming rate. The skyscraper of debt they had built was starting to sway. Throughout late 2007 and into 2008, Dick Fuld publicly insisted everything was fine. He projected an image of complete confidence, dismissing the rumor mongers and short sellers betting against his firm. But behind the scenes, a desperate scramble was underway. They tried to sell off bad assets, but there were no buyers. Everyone knew they were toxic. They tried to raise new capital, but investors were spooked. No one wanted to throw good money after bad. The firm that had once been a pillar of finance was now seen as a pariah. The decision to go all in on real estate had backed them into a corner from which there was no escape. They owned billions in assets that were now worth a fraction of what they paid, and they owed staggering amounts of money to their creditors. The final act came in a dramatic weekend in September 2008. The US government, which had bailed out Bear Stearns just months earlier, drew a line in the sand. Treasury Secretary Hank Paulson gathered the heads of all the major Wall Street banks and told them to find a private solution to save Lehman. A frantic series of negotiations took place. Bank of America and the British bank Barclays both considered buying Lehman, but they walked away. The hole in Lehman's balance sheet was just too big, too toxic. The US government refused to provide a bailout. The clock ran out. On Monday, September 15, 2008, Lehman Brothers, a firm with over $600 billion in assets, filed for Chapter 11 bankruptcy. The news sent shockwaves through the global financial system. The stock market crashed, credit markets froze, the too big to fail theory was shattered. The single decision to aggressively leverage the firm and bet everything on a booming housing market was not an isolated error. It was the culmination of a culture that rewarded recklessness and punished caution. The very qualities that had made Lehman successful, its aggression, its appetite for risk, its unwavering self-confidence, became the seeds of its own destruction. When the environment changed, the firm was unable to adapt. They were too invested, both financially and emotionally, in the belief that the party would never end. The story of Lehman is a timeless reminder that in finance and in life, hubris is often the precursor to a fall. It shows how quickly a legacy built over 158 years can be undone by one bad decision, fueled by arrogance and a denial of reality. Thanks for watching. If you found this story fascinating, don't forget to like, subscribe, and hit the bell icon so you don't miss our next episode of The One Decision.